Hello, everyone, and welcome to this Fintelekt Asian Bankers Association webinar on 2024 Crypto Review and Outlook for 2025. I am Karishma Dattani, Vice President at Fintelekt, and I'll be your host for today. I'm joined by Calvin Koo, crypto expert and cross-border disputes and investigations lawyer at Kobre Kim LLP, based in Hong Kong. Welcome, Calvin.
Thank you. Pleased to be here.
In this ever-evolving world of crypto, changes occur rapidly. And we are delighted to have Calvin with us for this biannual update, keeping us informed on the latest developments in the industry. For those of you who do not know Calvin, I'd just like to share a few words about him. Calvin's work involves counseling financial technology and Web3 clients in high-stakes investigations and litigations, global dispute resolution campaigns that require highly coordinated multi-jurisdictional activity, tracing digital assets on blockchain, advocating in courtrooms around the world to maximize recovery value, and pursuing both offensive and defensive strategies related to cross-border government enforcement matters and regulatory enforcement actions. Today, we'll learn from Calvin about the global legal and regulatory developments in the world of crypto, how to combat crimes involving crypto, and trends expected in 2025. We will have a Q&A round in the end. So participants, you can post your questions in the Q&A window at the bottom of your screen. Before we begin, I'd like to thank Asian Bankers Association, especially Mig Moreno, for partnering with us for this webinar. All right, with that, Calvin, thank you so much for being here on this webinar with us today, and I hand it over to you.
Great, thanks, Karishma. Again, thank you to Fintelekt and ABA for inviting me and organizing the event. Thank you to all the participants online for taking the time to join this webinar. I have a few slides I would like to share with you, so I'll go ahead and share that. So I'm very happy, again, to have this opportunity to share what's become a biannual webinar to share observations about the state of crypto. For those who have heard me before, you'll know that I'm coming at this as a lawyer. So I'm not a business or industry analyst, and I'm not necessarily trying to advocate for any particular policy position. But for my practice as a cross-border disputes lawyer, I have to familiarize myself with various issues that touch on compliance, criminal, and regulatory issues, including in this crypto space. So through that, I have some observations, which I think many in-house legal, compliance, investigations, government personnel may hopefully find useful for their own work or edification. And so here I must give my usual disclaimer at the start. Everything I say here, these views are my own, not that of my employer, and nothing I say should be taken as legal or financial advice. You should consult your own professionals for such advice. So the last time I spoke at this webinar was last summer 2024. And the one headline observation that I shared at that time was that there was a maturation of the industry. This year, I think the theme is a continued move away from dominating negative news cycles about crypto and into a generally more sober and sometimes optimistic, maybe even mundane framing of the crypto industry in mainstream reporting. So what do I mean by that? Perhaps it's easiest to offer a contrast. So before 2022 crypto winter, which is when a lot of crypto-related businesses crashed and the value of Bitcoin went down, etc. Before that period, the stories that you would see in the media were often pretty stark. So it was either, on the one hand, really bullish hype pieces, or a very aggressive dismissal of the industry writ large. Now, the stories, at least to me, when I'm following all of this, seem a bit less dramatic either way. And it's fallen into a more, vanilla, if you like, subcategory of financial and business reporting. Now, certainly there's going to be some exceptions. For example, recently there was a brief buzz about the tokens that were released around the US presidential inauguration. But in a way, those are really exceptions that prove the rule in terms of how things are being reported today. So overall, there's a view of this, again, mundane vision of growth of this technology and the businesses connected to it. So that could be startups, or it could be traditional institutions exploring how to utilize blockchain technology. And then there's often a factual presentation or a factual reporting of different regulations that are being developed around this industry. I mean, frankly, these days, when you're thinking about or listening or hearing about buzzwords and buzz industries and dramatic news, it's really surrounding artificial intelligence, isn't it? And not so much crypto anymore. But that loss of buzz factor for crypto doesn't mean that we should ignore it. To the contrary, maybe it suggests a move towards a more nuanced and objective thinking about what it is, what's actually usable, how can we use it, what's technically or favorably investable, and what is it that governments and businesses want to do about it now. And so really all of that brings us to today's session. Here's the agenda. What I'd like to do is cover some recent developments across a few areas. First, I'm going to spend a bit of time on what's happening in the US. Now, we're all in APAC here. I think most of us out here on this call are based in APAC. But part of the reason of focusing on the US is that it's had the most dramatic change of policy and approach of any major jurisdiction recently. And of course, the size of its economy affects the globe. So all of this, of course, is an outcome of the recent election and change in presidential administration in America. So we're going to spend a little bit of time on this. Second, I do want to highlight some new developments and updates in other parts of the world, including Hong Kong, Singapore, the UK, and Korea. Third, we'll discuss some global focus areas this year, including combating criminal activity. Then I'll end with some thoughts on what we might expect in 2025, the rest of this year. And also, as Karishma said, we can do some Q&A at the end. So start thinking about some questions that you want to ask. Okay, beginning with the US. Again, let me take us back to last year before the presidential election to remind us of the setting in the US at that time. What did we see in the last half of 2024 in the US? Well, there was a continued state of affairs in the US where the securities regulator, the Securities and Exchange Commission, or the SEC, took the view that pretty much all digital tokens except Bitcoin and possibly Ethereum were within their purview, within their regulatory purview as securities. And this was based on securities laws that were set in the US in the 1930s and the 1940s. Critics, industry groups, and dissenting members of the commission itself, which is a 5-person commission, and there were at the time 2 dissenting members, took the view, along with some federal trial court judges, that actually the law, as it applied to cryptocurrencies and digital tokens and coins, wasn't necessarily quite as clear as the SEC was alleging it to be. And in fact, many called for new and tailored laws and regulations over all facets of the industry. How to issue tokens, do we need licenses for brokers and exchanges? What are the details on how to comply with anti-money laundering requirements as it pertains to this type of technology, etc. But notwithstanding all of those calls, the SEC not only continued their enforcement campaigns based on the long-standing securities laws that began in a traditional securities context, but rather they expanded their enforcement campaigns last year. So they continued its litigation against major centralized exchanges like Coinbase, Kraken, and Binance. They continued litigation against issuers like Ripple, and they initiated new suits against other alleged intermediaries acting as purported brokers or dealers, such as by providing wallet services or providing market liquidity. They also fought against suits brought in courts by the industry against the SEC, including one that was brought by Coinbase, arguing that the SEC was required to make rules, new rules, rather than regulate by enforcement. So that was the state of play. And then Trump was elected in November and took office last month. And with that came a more pro-crypto outlook, or at least a more crypto-friendly outlook, including the nomination of a new chairperson of the SEC perceived to be crypto-friendly. Now, pending that approval and confirmation, there are currently 3 SEC commissioners out of the usual 5, but that's still a quorum, and now 2 of the 3 are seen as crypto-friendly, right? So those were the 2 dissenters last year. Now they are in the majority. One of them is the interim chair as well, by the way. So what does that mean for policy, laws, and regulations? And also, what does it mean for the enforcement cases? So on policy, the Trump administration moved pretty quickly after inauguration to issue executive orders related to crypto. So on January 23rd, which was 3 days after the inauguration, he issued an order called Strengthening American Leadership in Digital Financial Technology. In this order, he recognized that, quote, the digital asset industry plays a crucial role in innovation and economic development in the United States, as well as our nation's international leadership. It's therefore the policy of my administration, the Trump administration, to support the responsible growth and use of digital assets, blockchain technology, and related technologies across all sectors of the economy. Included in that is providing regulatory clarity and certainty built on technology-neutral regulations, frameworks that account for emerging technologies, transparent decision-making, and well-defined jurisdictional regulatory boundaries, all of which are essential to supporting a vibrant and inclusive digital economy and innovation in digital assets, permissionless blockchains, and distributed ledger technologies. So that was basically a list of all the things that those critics I mentioned before. It's a list of all those things that those people were criticizing the SEC for, and they were calling for these things instead of what the previous SEC was doing. So to that end, this new executive order also created a new working group to propose a regulatory framework for digital assets, bringing together high-level officials of various departments and agencies, including the SEC chair, the Treasury Secretary, the U.S. Attorney General, the Commerce Secretary, Homeland Security Secretary, Commodities and Futures Trading Chair, and others. So senior cabinet level officials are part of this working group, showing how much of a priority is being placed on this. The executive order also revoked certain crypto-related policies and directives issued under the Biden administration's Treasury Department. So next month, different federal agencies are going to have to submit recommendations about rescinding, modifying, or adopting various regulations in the digital asset space. So probably a pretty big switch from the policies and regulations under the Biden administration. And then by late July, the working group is supposed to submit a report to the president with different regulatory and legislative proposals. And beyond this multi-agency working group, the SEC itself has created a new crypto task force. The theme and goal is the same. And they've said that and this is another quote, the task force will collaborate with commission staff and the public to set the SEC on a sensible regulatory path that respects the bounds of the law. To date, the SEC has relied primarily on enforcement actions to regulate crypto retroactively and reactively, often adopting novel and untested legal interpretations along the way. Clarity regarding who must register and practical solutions for those seeking to register have been elusive. And the result has been confusion about what is legal. It creates an environment hostile to innovation, and it's conducive to fraud. The SEC can do better. The task force's focus will be to help the commission draw clear regulatory lines, provide realistic paths to registration, craft sensible disclosure frameworks, and deploy enforcement resources judiciously. It's pretty strong criticism of the previous approach. And just last week, the head of this task force, Commissioner Peirce, set out some priorities. If you actually go back and look this up, she first began with an interesting analogy. She described a long car trip that she would take as a child years ago in the pre-internet and mobile phone age, right? So they used paper maps, right, instead of GPS. They listened to local radio stations. They looked out the window as their entertainment on a long drive. If there was a problem with the car in a remote area, there was no mobile phone to call for help. So technology has made trips more enjoyable and less risky in many ways. She then called for this new task force to similarly embark on a more enjoyable and less risky crypto road trip than what the SEC had been doing previously over the last decade. She said, on that last trip, meaning the prior administration, the commission refused to use regulatory tools at its disposal and incessantly slammed on the enforcement brakes as it lurched along a meandering route with a destination not discernible to anyone. But just as modern technology does not eliminate the risks of taking to the open road, this new journey toward regulatory clarity still presents dangers, and both the commission and the public need to stay alert and aware of the risks and opportunities that may lie ahead. So that's her theme. There are still risks, but there are also opportunities, and the way to handle those will be different than before. A few more select quotes about their priorities. They want to travel to a destination where people have freedom to experiment and build interesting things, but which will not be a haven for fraudsters. The task force works to help develop this regulatory framework, and as it does so, it'll give careful consideration to anti-fraud protections. If the commission spots fraud that lies outside our jurisdiction, it can refer the matter to a sister regulator. If it does not fall within any regulator's jurisdiction, the commission can bring that gap to Congress's attention. Task force is working to help create a regulatory framework that both achieves the commission's important regulatory objectives, including protecting investors, and preserves the industry's ability to offer products and services. Some of these rules will impose costs and other compliance burdens that some may find irritating, and the commission will use its enforcement tools when necessary to pursue non-compliance. We'll collaborate with others across the government, states, and with international counterparts. So the overall message is a positive one for those supporting crypto industry growth, but she slid in a few things to manage expectations, recognizing the need for compliance work and that it's going to be costly, and recognizing that they, as a regulator, can't do it alone, but have to work with others within the country and also beyond it. She also set out a list of 10 non-exhaustive products and issues that they will tackle, but this isn't set out in any order of priority, but they're going to tackle the status of crypto assets as a security or not a security, paths to registration, whether crypto lending and staking is covered, and also a cross-border sandbox, recognizing that many crypto projects are international and cross-border. So stay tuned for details on the new policy, laws, and regulations. Now that's all well and good moving forward, but what about the existing SEC investigations and cases we mentioned? Can they really just go from years of ramping up and filing enforcement actions to making a sudden U-turn? So on that point, Commissioner Peirce has also said that the commission's handling of crypto has been marked by legal imprecision and commercial impracticality. Many cases remain in litigation. Many rules remain in the proposal stage, and many market participants remain in limbo. Determining how best to disentangle all these strands, including ongoing litigation, will take time. Please be patient. It requires work across the whole agency and a lot of cooperation with other regulators, but they need to do this in an orderly and practical way. So what does it mean to be practical? There's a few different paths forward, given the clearly stated new policy direction, focusing on new regulations rather than enforcement based on an older, arguably unclear set of securities laws. So when the SEC Enforcement Division investigates a potential violation of securities laws, they gather information and have discussions with the targets of the investigation, or probably their lawyers. So the SEC may reach a point where they issue what's called a Wells notice, laying out the theory of their enforcement case and giving that target an opportunity to argue why the SEC shouldn't initiate an actual enforcement suit against them. At this stage, the way forward is basically in the SEC's control. They get to largely decide the timing and the course forward. They hold the ball and gets to set what happens next. But if and when the time comes that the SEC decides to file a suit based on these alleged securities violations, the game shifts, the rules shift. They file in a US federal court, and then the process becomes like any other civil suit in the US federal court, which is subject to federal civil procedural rules and overseen by a federal judge. So the way forward on all these individual matters depends on where in that life cycle of an investigation and suit it was when the policy shifted. So for some cases that are still in the investigation phase, the SEC can decide to just drop the case entirely if it wants, or it could continue to invest resources into it. For example, the SEC may decide that investigations that are based on simple registration violations, meaning failure to register something under the securities laws, maybe those should be dropped. That kind of seems in line with their current policy that new regulations are needed about registration. But if the investigation includes an allegation of fraud or misconduct, then maybe they'll continue with the case, because that touches on the consumer protection part of their regulatory remit. It's a little more complex for cases that have already been filed in court, including registration violation matters in court. The SEC can't really just decide themselves to drop it without procedural formalities, right? So it could opt to seek to voluntarily dismiss some of these cases, and there's court procedures to do that. But another possible outcome is that they'll reach some kind of settlement with the defendants, perhaps on terms less onerous than if this were under the previous administration. And these might be terms that the defendants are willing to agree to. So for example, and this is just through public commentary by others, you might see settlements requiring new and stronger internal compliance programs, meaning we'll end this case, but you, the defendant, have to improve your compliance programs. Or for non-fraud or non-intentional misconduct cases, the thinking is that the SEC is unlikely to want to spend a lot of time and more resources litigating all the way to trial, which takes years, on a legal theory that the current administration doesn't even believe in. So all told, these cases are in a state of flux. There's even key senior enforcement lawyers that were shuffled around within the agency. Reportedly, this even includes a lawyer who previously ran the agency's special crypto enforcement unit, as well as 50 other lawyers and staff members within that unit. And I can actually speak with experience based on some cases that I'm handling now, that all these developments feed into the ever-evolving legal strategy and expectations of case outcomes. The SEC has publicly filed requests for more time to file written submissions that are due in multiple ongoing cases, citing the task force and how the task force work may impact and facilitate the potential resolution of cases. So by getting an extension or a stay of a case, all sides in the court can save judicial resources until the SEC policymakers decide how to address these cases. And just as a final point about the US, a lot of the above is focused on the US executive branch, meaning President Trump's policies, and also executive agencies that fall under the president. But the legislature is also signaling more pro-crypto policies, given the executive support. They've said that they want to provide innovators with new tools and basically introduce new bills that support that. Last week, there was a bill called for stablecoins called the Guiding and Establishing National Innovation in U.S. Stablecoins Act. The acronym is GENIUS Act, GENIUS. So sometimes I wonder how much time these legislative aides actually spend to come up with these acronyms. But the act purports to define payment stablecoins and set up issuance procedures. But some representatives, especially on the Democrat side, expressed doubts about it and continue to express doubts about crypto generally. So enough with the US, but there was a lot to cover there. Let's move on to other parts of the globe. But sticking with stablecoins for a second, what's happening in Hong Kong? So if you joined last year, you heard me mention that Hong Kong had conducted a public consultation on proposed stablecoin regulations with results released last July. They also launched a regulatory sandbox for stablecoin issuers, which is a period during which regulators allow companies to test proposed services and products. In December 2024, the Hong Kong government formally introduced the stablecoins bill into the legislature, and it covers licensing requirements, offering and marketing rules, and consumer protection measures. Now, this is important because I've mentioned the notion that the world is still trying to figure out the key use cases of cryptocurrencies and different types of digital tokens. It seems that stablecoins are one area that's in the lead in terms of actual or perceived usefulness. And these are the tokens that are tied one-to-one with often fiat currency, and often that means the US dollar. So unlike Bitcoin, whose value goes up and down, sometimes wildly, these tokens are meant to always be tied one-to-one to the US dollar or whichever fiat currency you like. And that's just for those of you who may not be aware. So I've seen one report that said stablecoins are projected to grow significantly, potentially reaching $3 trillion in market value over the next 5 years, driven by their utility in payments and remittances. That also potentially makes it ripe for being used for improper purposes or as facilitation of money laundering or crime. So having regulations in place as a priority does make good sense. For Hong Kong, their first priority back in 2023 for crypto regulations was regarding centralized crypto exchanges. And that made sense if you remember that in 2022, that was when exchanges like FTX collapsed, especially in light of growing popularity of retail trading. So first focus, deal with centralized crypto exchanges regulations. Their second priority is this, the stable coins. And that's for the reason just mentioned. Many think Hong Kong will next move on to custody rules, which be relevant to brokers and other intermediaries in this space. On that, there was also a recent Hong Kong court case touching on this issue. I've mentioned before that Hong Kong courts have been pretty good about this novel area, making clear judicial interpretations about crypto as property and what that means for proprietary remedies in various disputes involving crypto. 5, 6, 7 years ago around the world, it wasn't even clear if crypto, which is obviously intangible, was property in the legal sense. It's now pretty clear in many jurisdictions that it is. Now, last month, the Hong Kong case involving Gatecoin gave more clarity about how to handle a situation where a customer has cryptocurrency held at an exchange or with a custodian that's insolvent. It talks about the nature of the customer's beneficial interest in the crypto and how liquidators should allocate such cryptocurrencies and in what proportions in cases of insolvency. I'm not going to get into technical weeds, but the point is these issues are being addressed, right? And this underscores how the law is evolving to tackle fact situations that are coming up more and more, meaning there are all kinds of disputes, including bankruptcies, where crypto features as one type of asset or property. So the law needs to be clear on how to handle these situations, and increasingly it's able to do so. And this is not to suggest that Hong Kong is alone in this regard, but it is useful for Hong Kong's general pursuit of being a crypto hub. The UK and Singapore, the courts there have also addressed many proprietary issues over the last year relating to crypto. The UK addressed issues on liability of exchanges for fraudulently misappropriated cryptocurrency. There was a case, Aloya versus Persons Unknown. Court found in favor of the exchange on the facts, but the decision made it seem like that if there was tracing that was involved that had tied it to the exchange and you could clearly show that it was misappropriated, there was a chance that the exchange could have been found liable, right? So this goes to the point of, just like in traditional finance, when can a traditional bank be held liable if misappropriated money flows in and out of it, right? Same idea, similar idea. So the UK also saw the introduction of a digital assets bill, recognizing the unique technical characteristics of digital assets, meaning they needed a statutory recognition of a third form of property under statute. For the longest time under the law there were 2 types of property, and this is going to be a third type of property. And by being in a statute, it gives it a legal recognition that's a little more certain than judicial decisions. In Singapore, courts have found that crypto, again, is property, and they've also dealt with insolvency law issues as well. They've also dealt with novel issues like where is the location of a crypto asset, right? Again, not physically tangible. There's arguments that it's in the jurisdiction where the claimant is resident, or maybe where the owner is domiciled. In one case, they decided it was best determined by looking at where it is controlled instead of residence or domicile. A different case also addressed a way to value cryptocurrency, meaning for those tokens that do go up and down in value, how do you assign a specific value to it on any given moment, which may be relevant to damages or remedies in a court case? Again, these are all decisions that are necessary to deal with a growing number of everyday issues that involve crypto as an asset in a fact pattern that gets to some dispute. South Korea, very active crypto market. They had a new act, the 2024 Virtual Asset User Protection Act, that was made effective last year. In light of crypto trading volumes in Korea, it doubled between September and October 2024, 5.45 trillion won to 9.56 trillion won. The financial services regulator there pushed for new regulations to address increased market risk. Many applauded its proactive effort to combat market manipulation in virtual asset trading, but others expressed concern over its broad definitions and potential impact on common market-making activities that were legitimately used in other financial markets. This is because the statute's broad use of the term market making without further guidance or established precedent means that practices that may be common or acceptable elsewhere, including within traditional Korean securities markets, could now be prohibited or subject to heightened scrutiny and enforcement. And I cite this because it really highlights the challenge found in many jurisdictions in identifying not only the right policy, but also the execution of it, right? If you give too little guidance, like in the US generally, or maybe under this Korean Act, it can cause lots of confusion for the industry about what is and isn't allowed. But then if you spell things out too much, it potentially offers an easy opportunity for bad actors to find workarounds without legal consequence should something bad happen. Of course, none of this is unique to crypto, but the fact that it's a new technology with policymakers and legislators are still learning about it, with the industry developments, the technology developments outpacing them, it just creates a very modern challenge. Okay, how about combating crypto crime? You know, one of the most important challenges, and one that's perhaps relevant to many joining this webinar and to the work of Fintelekt members, is combating crime, including prevention of laundering of criminal proceeds through the use of cryptocurrency or digital tokens. Now, at the outset, I mentioned a change in tone of how crypto stories are reported. And with some exceptions, I think that's the case with crypto-related crime too. So unlike before, where there were many observers suggesting that the whole industry was a scam, now the more mainstream view is that there is some burgeoning industry here with potential real use cases, albeit to be determined, right? And the analogy here is, if you think back to the mid-1990s when the internet started growing, people didn't really know how it was going to be used. A lot of people didn't envision it's the way it's being used now, right? So too with crypto. Seems like there's something here. There may be real use cases, but what those specifically are, we don't quite know yet for sure. And that, like any new technology, there is a risk of individual scams. So that's an important evolution in the mainstream thinking, from industry-wide suspicion to concern about the abuse of the technology through specific bad actors, right? And that's not to say everyone feels this way. Of course, there remain many skeptics, maybe some on this webinar, but this is just a general observation of trends that I'm seeing in this space. So what does that mean in practice as far as combating crime? It could be more targeted focus by specialized police against scams, like romance fraud scams, investment fraud scams that have become so prevalent in Asia and beyond, as well as broader national security units, where there is a concern that crypto may be used to circumvent geopolitical sanctions. So for example, the US government has a concern about crypto being used to funnel money to its adversaries in the Middle East or to North Korea, for example. And even here, there are complications and debates, such as whether the use of mixers like Tornado Cash should itself be considered a crime or evidence of facilitating a crime by aiding money laundering. Others might say the use of mixers, which makes it harder to, which sort of obfuscates the trail and the tracing of where cryptocurrency has been. Some might say that's a legitimate privacy tool, but it's certainly a tool that could be misused by some, right? So there's ongoing debates about that. Now, depending on those choices and the priorities of a particular jurisdiction, compliance teams will have to figure out how to manage varying levels of suspicious activity and KYC obligations. Now, of course, you may be familiar, there's global best practices set by FATF, but I'm sure many of you will agree often it's much easier said than done when it comes to practicalities and having the useful software and training for human talent. Maybe that's where the buzzword of AI will come in. But compliance teams and professional advisors for those in this space must pay careful and constant attention to the evolving laws and requirements and regulations. And it's really tricky when it's a global market that remains wildly inconsistent in terms of progress of implementing laws and standards. Okay, so what do we see, or what do I see for the rest of 2025? I've kind of touched on it, frankly, already in this summary. But I do think there's going to be an evolution in global regulatory priority areas. This has already started in some places, like the Hong Kong case I've mentioned. But I think the main areas are different jurisdictions will address exchange licensing for places that haven't addressed that yet, stablecoins regulation, then custodial rules, then tokenization rules. Tokenization is the taking of real-world assets and identifying them through a token, which in theory may make it easier to trade, share more efficiently, trade or share, or break it down into smaller units. That's a real popular potential use case that many builders are exploring these days. The pace is going to be different across jurisdictions, but for those places that are investing in this space, I think we're fully getting into the details phase of laws and regulations. So it's no longer just broad stroke policy positions and the announcement of study papers, but as the global market moves ahead quickly, folks have to put pen to paper, which is actually a bad analogy for crypto since it's anachronistic, but actually craft and explain the rules. As noted earlier, sometimes that means potential hiccups with some laws that may be too broadly crafted without specific terms. But we can't let perfection get in the way of progress. So having something is probably better than nothing for most participants in the industry. So let me leave it with that. Thank you. Thank you for indulging me for the last 30, 40 minutes and just throwing that at you. But happy to field any questions if there are any.
Thank you so much, Calvin, for that interesting and very informative presentation. Before we move to the Q&A session, may I request my colleague to please pull up the poll that we have. We have one poll, and I request all the participants to please respond to that. So the poll is, how has your institution's approach to crypto-related AML risks evolved in 2024? It's a multiple choice question. We'll run it for another 30 seconds. All right, can we close the poll and get the results on screen, please? So Calvin, any view on this?
Let's see. The even spread, so strengthen monitoring, that makes sense, and that's consistent with what I was saying earlier. There's a need for that, but I think the various industries and traditional firms and startups recognize the need for that and are building that in. Increased engagement with regulators, that's great. Due diligence expansion, yeah, all of these things. Reduced exposure, that's interesting. I would say a lot of places are increasing exposure, but I can appreciate that some places may be taking a different view, or the laws have changed in that jurisdiction that necessitate that. So yeah, I think it generally shows a trend towards the recognition, whether or not it's favorable for any particular situation, but the general recognition that this is a growing piece of global finance and many people's business, and accordingly, there needs to be the changes that are listed in those choices.
All right, thank you so much. So let's move on to the questions. We have one question from Azmat. What is the regulatory framework for crypto-based Islamic financial transactions, and how do we make sure these are fraud-free?
You're trying to stump me on this one. So I don't want to speak completely out of turn. I don't fully know the answer to that. I haven't worked on that type of transaction specifically. But what I will say is my best guess is to look maybe at what's going on in UAE and Dubai and Abu Dhabi in particular. Well, Dubai is really pushing ahead to be a virtual asset hub. Abu Dhabi also has rules, and they have Emirati level rules and Dubai specific rules. And I know Dubai has like the sort of a free zone, but they've spent a lot of time refining those laws. And I have worked on a matter where we had to look at the situation in the UAE and Dubai. And as part of that, we did have to consider Sharia, how that would apply and things like that. So I don't know that there's a single answer yet for a global framework, but the leader among countries in that region that may see this type of transaction more often would be Dubai or at least the UAE. So I would say look there. And how do you make sure these are fraud-free? Again, the framework tries to balance those considerations like regulations everywhere between innovation and protecting the downside risks.
Makes sense. Thank you. We have one from Jay. Is there any acceptable crypto transaction documents, maybe in stablecoins, particularly in a similar wire transfer space, that is equal to the MT103 of the banks, thus serves as an acceptable document to any Bureau of Customs in some countries?
Again, a very specific and somewhat technical question. I don't know the very specific answer, I'm afraid, but in general, in terms of crypto transaction documents, this is kind of one of the areas that where the best practices and the compliance best practices are evolving with the way the technology operates, right? So whether there are tokens where you can embed messages and embed information, travel rule information, things like that, that then can be preserved. The traditional functions and the traditional regulators like that type of process and want to see it built that way. Some of the engineers and builders don't necessarily see that as quite so easy or quite so easy to collect that type of information. So they're a bit at odds. In some cases, regulators are, they're not proscribed a way to do it, but they're kind of leaving it open to the industry to figure out the right way forward and show them that it meets all these requirements. So I think stay tuned to see how those documents and the type of information you'd preserve get progressed in different jurisdictions.
Okay. So Calvin, we received some questions when people were registering. So I'm going to pick up one from that. Do you think it's possible to effectively regulate cryptocurrencies while maintaining their decentralized nature? Or will that have to change in order for crypto to get fully integrated into our financial system?
Yeah, I think we are at that period where it is changing because it's being integrated in the financial system. When I started doing this work around 2017, and frankly, some of the clients I worked with who were sort of at that early stage, true believers in the philosophy of decentralization and what cryptocurrency meant, no centralized institutions. Again, for those of you who may be unfamiliar with the history, Bitcoin was an outgrowth of the 2008 financial crisis, right? And so people at that stage had a tremendous lack of trust and faith in the centralized institutions, believing it was those institutions that caused all the problems, right? And so people I dealt with back then, they were very resistant to the idea of any type of regulation because it was so fundamentally against the whole point of the technology. I think that's changed as kind of a little bit of the theme here where even people who don't necessarily believe in the philosophy of it see that it's part of the ecosystem now, or at least enough other institutions and enough other players in the financial market see it as an asset, or some of the digital assets as an asset. And if that's the case, and it's reaching figures in the trillions of dollars of whatever business, then there just has to be regulation. And that's where we're seeing these governments finally recognizing that for a few years, like, okay, let's explore this. Is this really a thing? How much of a thing is it? it's a thing now. Again, you don't have to believe in it, but it's a thing now. And so the governments have to act.
So another one from the registration list. Are there successful prosecutions already from perpetrators of money laundering using the crypto to channel proceeds of crime?
Yeah, I think so. I mean, certainly in the US, the Department of Justice has been very active in these cases, both in terms of the prosecution and the recovery of assets. I'm trying to remember the name. I can only remember. So there was a couple in the US, and the female of the couple also had a rap name. That's the name that I can remember. I think it's like Razzle Khan or something. So you can look that up. And they were alleged to have been handling money, not money, cryptocurrency that was stolen. So if I'm remembering correctly, the allegation against them wasn't the actual theft or the hacking of the cryptocurrency, but it was the subsequent handling of it, right? And they were prosecuted, and the Department of Justice had this whole tracing exercise that it's publicly reported. You could see the FBI report on how they figured out and how they traced what otherwise was thought to be, anonymous or pseudonymous wallets. So it's possible. Now, it is resource heavy. Perhaps no coincidence that among the more successful cases is the US Department of Justice, because they have the resources to invest in this kind of thing. But I think as things progress and more law enforcement agencies around the world get more sophisticated about these things, you'll see that more often. Now, the bad actors may also get more sophisticated, but again, then this isn't any different than traditional finance.
I'll just pick one last question since we are out of time. With blockchain technology accelerates transaction, making other wire transfer requirements irrelevant, that is Swift code, routing code, etc. How does a company establish policy process about disputes and frauds, and how it can enforce them between countries and companies involved in the transaction in a dispute?
So I think what I'm hearing is like if you need to like undo the transaction or send them. I mean, that's another tricky one. So again, this is where many regulators, many policymakers want to put new crypto regulations in the mold of traditional finance regulations, because they may have felt like most of the problems of traditional finance and most of the disputes in traditional finance, such as the one you just described, have been adequately covered by those things. And I think the pushback comes in like when it doesn't technologically work quite the same way. When the government and when regulations rely on a centralized entity to affect a return of funds or to require a one or T1 with T2, and you have time to dispute and turn it back, then there's somebody that you can go to that can affect that return of funds. And if it's just peer-to-peer, person-to-person, that doesn't exist. From an individual's perspective, again, the philosophers will say, well, that's the whole point. We want it to be individual to individual, and you take on the risk yourself. I think a lot of governments will see that a bit extreme, especially from the consumer protection perspective, things like protecting grandma from frauds and things like that, which is why governments and regulators are putting in requirements for centralized entities to take on the responsibilities that traditional finance has. And then the big question going forward, and I'll stop there, is as centralized entities start to have these compliance rules and do these things, will a certain segment of the business and the industry move to decentralized finance, which again, peer-to-peer, where there is theoretically no entity that the government can oblige to do this deputized compliance work? I think that probably will happen. And what the answer to that is, I don't know. Maybe we'll have to see a couple webinars from now.
All right. Thank you so much, Calvin. We have a lot of more questions, but we'll close here in the interest of time. Participants, you can connect with Calvin directly on LinkedIn to engage with him. Thank you so much, Calvin, for today's webinar. It was very informative, and thank you for taking the questions. I also would like to thank the audience for being here with us today. I hope you had a lot of takeaways from the webinar. My sincere thanks to the Asian Bankers Association for partnering with us on this webinar. We also conduct virtual workshops in association with ABA, and I urge participants to take a look at the list of our upcoming workshops on our website. My colleague will post a link to the page on the chat window. With that, I would like to close this webinar. Thank you so much, Calvin, once again for being here. And I look forward to our next session with you in 6 months. Thank you.
Thank you, everybody. Appreciate it.